The euro tumbled overnight after the Cypriot Parliament voted down the bank levy plan, which was tied to the country's international bailout. The final version of the controversial plan intended to raise €5.5 billion from deposit taxes and excluded those with less than €20,000 in their account. The vote ended with 36 MPs voting against it, 19 abstaining and 1 absent, with not one single MP endorsing the plan. The Cypriot President said people think that it is unjust and it's against the interests of Cyprus as a whole. The Dutch finance minister said he's disappointed by the outcome, but noted that the conditions of the proposal are still valid. He also pledged that the EU stands ready to assist Cyprus in its reform efforts. An immediate question is on the European Central Bank's stance towards Cyprus. After being downgraded to junk status by all three major rating agencies, Cypriot bonds were ineligible as collateral in the ECB's refinancing operation last year, and the banks turned to Emergency Liquidity Assistance from the Central Bank of Cyprus. The central bank was only allowed to lend to the banks with the permission of the ECB's Governing Council. That council will meet today regarding the situation in Cyprus and will decide whether to give the island country more time or to cut off the liquidity to banks. Somewhat alarming media reports overnight indicate that the Cyprus government is working with EU officials to impose capital controls. This would be very unwelcome news, as it underscores the seriousness of the situation. Needless to say that free movement of capital is at the core of the EU internal markets, and capital controls in Cyprus would be an extreme measure. It is equally worrying that the Cypriot Prime Minister has overnight said that the government is considering nationalising pensions. Meanwhile, Cypriot Finance Minister Saras will fly to Moscow to present a plan to Russia, which is a major player in the banking sector. The UK will be a major focus today, with Chancellor Osborne delivering his fourth budget. A focus is whether Osborne will announce to push back the debt-to-GDP ratio of 75% to the 2017-2018 fiscal year, as well as prolonged austerity beyond 2015. Also, there could be measures that boost bank lending to businesses to strengthen the economy. The Bank of England will also release meeting minutes, and the attention will be on the vote for expanding the asset purchase programme. The UK will also release job market data, which could show a 5,000 fall in the claimant count in February, while the unemployment rate is expected to be steady at 7.8%. The British pound has somewhat stabilised in the past 2 weeks, with British pound US dollar holding above the 1.5 psychological level again. Euro pound also managed to stay below 0.88, and British pound Australian dollar recovered after hitting a historical low of 1.4380. But the British pound remains vulnerable to deeper falls against most major currencies. In the US, the Federal Open Market Committee rate decision will be a major focus of the day. The Fed is widely expected to keep rates unchanged, along with the open-ended QE3 program. The question is firstly whether policymakers will be encouraged by the recent improvement in the economy, in particular in the job market. The Fed will also release its updated forecasts, and markets will be eager to know if they will raise GDP projection and lower unemployment projection. Recent strength in the greenback was mainly due to risk appetite on dollar-denominated assets. US stock indices hit record highs on expectation of improvements in the economy and the Fed maintaining its stimulus program. So an optimistic view from the Fed with a pledge to maintain stimulus will give the dollar and the US stocks a further boost. The Forex market is pricing an increasing probability of a negative tail risk in Europe from the situation in Cyprus, e.g. contagion in European banks from banks failing in Cyprus, a euro exit, etc. This has pushed euro-US dollar below 1.29, and the euro is unlikely to find many buyers today, as the Federal Open Market Committee meeting holds the potential to display the different views on the Fed's quantitative easing within the committee. Short positions are becoming more stretched, but most likely there is room for trading accounts to add if no solution is found in Cyprus or if the Federal Committee signals a higher probability of an early quantitative easing exit. For all the news affecting the Forex markets throughout the day, join us at forexcurrencytradingonline.co.uk. That's forexcurrencytradingonline.co.uk.